Well, speaking of financials, let's turn now to merger and acquisition activity and a lot of other things. But global deal-making activity, it did surge, $1.3 trillion recorded in the last quarter. Joining me now is Blair Effron. He's the partner and co-founder of Centerview Partners, of course, which advises on many of those deals. I want to get to a lot of things with you this morning, if I can, Blair, but we'll start off on merger and acquisitions. And let's leave SPACs to the side for a moment and just talk about strategically driven mergers and acquisitions. What are you hearing from clients in terms of their willingness to engage and think about doing deals?
David, the right question, and you framed it the right way by leaving SPACs off the table. If you look at the first quarter, 25% of the volume was actually SPAC related. If you take that out, what you saw in the first quarter was a very durable and stable M&A market. It's the same kind of market we've had for the past 6 or 7 years, irrespective of underlying economic activity. And this is frankly pretty symbolic of CEOs, of boards looking at M&A still as a tool to increase capabilities. Obviously, there's disruption in every business, every sector. So how do I get new capabilities to operate and take on those challenges? You see desire to get into new markets, new products, new geographies. And if anything, I would say that COVID has sped up the planning process for most companies quite rapidly. If it was a 3 to 5 year plan previously, you've seen their business models accomplish certain goals in 18 months. And because of that, many companies are really saying, if I have to move even more nimbly, more quickly, what kind of skills do I need to acquire rather than necessarily build internally? And that's been a real driver. You've seen it in valuations also. Valuations are robust. 14 times or so EBITDA today. If you look at a 5-year average, it would have been closer to 11.5 to 12. And I think also that tells you that investors are willing to support and CEOs are willing to make decisions that they think will lead to enhanced growth over time.
What about the larger deals? You know, when a company is thinking about doing something that will attract our attention, certainly, and the imagination of many investors, whether it be transformative or simply large, are they given pause at all by still trying to sort of figure out the antitrust approach from the Biden administration?
I think that's a valid perspective, and I don't think it's just the regulatory environment. Clearly, in the beginning of any administration, what we've seen is the first few quarters, the market companies take a pause on doing acquisitions or moves that are considered very large and very transformative. You want to know that you have a certain framework that you're operating against. You want to know what it takes to get a deal from a signing to a closing, what's the time period. So clearly that is an important part of it, number one. Number two, I would say that when certain areas of the market overheat, like the SPAC market, it actually causes thoughtful companies to step back and say, are we doing this at the right moment? And or should we wait for things to stabilize? I think the best time for an M&A market is when you have good growth, but not outsized growth. And It's also obviously an easier way to figure out how to price an asset.
Shepard Smith here. Thanks for watching CNBC on YouTube.